You're in the left seat. It's dark outside. You're at cruise altitude, 37,000 feet. Engines humming. Everything feels smooth now, but for the better part of an hour, you've been flying through rough air. Passengers are nervous. The cabin is uneasy. People are starting to question whether this flight is still on track. And then you check your instruments. Airspeed, climbing. Engine performance, nominal. Fuel burn, efficient. And out the windscreen, you can just start to see the lights of the destination city on the horizon. The turbulence was real, but the flight path intact. That is exactly where I found myself when I opened Alphabet's Q1 2026 earnings report. This is Captain Pierce. Welcome back to SkiesCapital. Tonight we're logging a captain's log entry on Alphabet, ticker GOOGL. Results were reported April 29th, 2026, and there is a lot to cover. So settle in. We're going under the cowling on Alphabet. Search, cloud, AI, margins, capital spending, and whether this quarter strengthened or weakened the long-term thesis. Before we dive in, one quick note. At SkiesCapital, a captain's log is not a highlight reel. It is a disciplined review. What mattered going into the quarter, what the numbers actually showed, what went right, what still needs monitoring, and what the thesis verdict is coming out the other side. We do not react to headlines. We read instruments. All right, let's go. Every good captain's log starts before the flight. Before you react to the turbulence, you need to know what instruments you were watching coming in. Otherwise, you are just reacting to headlines, and that is not how we do things at SkiesCapital. Now, to be clear, this is our first public captain's log on Alphabet, but Alphabet is a company I own, and I have been monitoring it personally. So before we get into the numbers, I want to lay out the owner's checklist I was watching coming into this quarter. Google Cloud trajectory, AI search disruption risk, capex discipline, and the antitrust overhang. Number 1, Google Cloud trajectory. This was the cleanest signal in the quarter. The owner's question was simple. Was cloud acceleration real, or was it just a one-quarter burst? Verdict, validated. Google Cloud revenue grew 63% to $20.0 billion, and backlog nearly doubled quarter over quarter to more than $460 billion. That tells me the acceleration is real. I'll go deeper when we get to the numbers. Alphabet's release also showed total revenue of $109.9 billion, up 22%, and operating margin expanding to 36.1%. Number 2, AI search disruption risk. This remains active. ChatGPT, Perplexity, and other AI native competitors are real threats to watch. The question is whether users start routing around Google search entirely. So far, Q1 did not show visible damage. Search and other revenue grew 19%, and management said search queries reached an all-time high. That is not a business under siege, but I am not calling this cleared. AI disruption is a long duration risk, and one strong quarter does not close the book on it. Number 3, capex discipline and ROI. This is the elevated watch item. Alphabet spent $35.7 billion on property and equipment in Q1 alone. That is a massive AI infrastructure commitment. The question is not whether AI matters. The question is whether this level of spending converts into durable returns. So for now, capex stays on the checklist. Number 4, antitrust overhang. This is not cleared, but it did not hit the quarter. Regulatory risk remains a long-term overhang, especially around search distribution and potential remedies. But in Q1, there was no visible disruption to operations or advertiser behavior. So here is the pre-flight readout. Cloud trajectory, validated. AI search disruption, active watch. Capex discipline, elevated watch. Antitrust, long-term watch. That is the baseline. Now let's look at what the instruments actually read. All right, here's the instrument panel for Q1 2026. Total revenue, $109.9 billion, up 22% from Q1 2025's $90.2 billion. That is a major acceleration for a company already doing more than $100 billion in quarterly revenue. Alphabet is not growing off a small base. This is scale with acceleration. EPS came in at $5.11 diluted, but I need to flag something important before we go any further. That number includes an estimated $2.35 per share benefit from non-cash equity gains, essentially paper gains from investment holdings increasing in value. Excluding that estimated benefit, EPS would be closer to $2.76. That is not a red flag, but it it is an important adjustment. When I'm evaluating Alphabet, I do not want to anchor on headline net income alone. I want to focus on operating income, free cash flow, and the durability of the core business. Now, the headline of the quarter, Google Cloud. Cloud revenue hit $20.0 billion, up 63% year over year. That is the brightest green instrument on the panel, and I'll come back to it because this may be the most important signal in the entire quarter. Operating margin came in at 36.1%, up about 2 percentage points from last year. That matters because Alphabet is expanding margins while also spending heavily on AI infrastructure. Q1 property and equipment purchases were roughly $35.7 billion. That combination, margin expansion plus massive infrastructure investment, is rare. Now let's walk through the segment breakdown. Search and other, $60.4 billion, up 19% year over year. Captain's View, strong. Search queries reached an all-time high. So at least in Q1, the AI disruption fear is not showing up in the numbers yet. YouTube ads, $9.88 billion, up 11% from the prior year. Captain's View, solid but softer than expected. This was the one area where the quarter was not as clean. But let's be clear, 11% growth is not a broken business. Google Cloud, $20.0 billion, up 63%. Captain's View, major acceleration. Backlog nearly doubled quarter over quarter to more than $460 billion. That number is extraordinary. It gives Alphabet much better visibility into future cloud demand, especially around AI infrastructure and enterprise AI. Subscriptions, platforms, and devices, $12.4 billion, up 19%. Captain's View, strong. This includes areas like Google One, YouTube subscriptions, and hardware. Alphabet also said total paid subscriptions across the platform reached 350 million, with YouTube and Google One as key drivers. Other bets, $411 million of revenue, down from $450 million last year. Captain's View, small and still loss-making. Other bets posted an operating loss of $2.1 billion. Waymo did pass 500,000 fully autonomous rides per week, which is an important milestone. But financially, this is still not a major contributor. So here is the readout. Search is strong. Cloud is accelerating. Margins are expanding. EPS is noisy because of the equity gain. And the only soft spot was YouTube ads. Still growing, but not the cleanest part of the quarter. Bottom line on the instruments, mostly green, with one amber light and one big watch item still ahead, capex discipline. Let's talk about what genuinely impressed me this quarter. 4 things stand out. First, cloud acceleration is real. Google Cloud grew 63% to $20.0 billion in a single quarter. Backlog nearly doubled quarter over quarter to more than $460 billion. That is not a small signal. That tells me this is not just a one-quarter pull forward. There is durable demand building behind the business. Alphabet specifically said cloud growth was driven by enterprise AI solutions, enterprise AI infrastructure, and core GCP services. That backlog deserves a moment. This is not management giving us a dream scenario. It is visibility into future demand that customers have already committed to in some form. The pipeline is loaded. The question now is how fast that backlog converts into recognized revenue and how much margin Alphabet can earn as it scales. For the thesis, this validates the core bull case on GOOGL. Google Cloud is becoming a genuine third pillar of this business, not just an optional side segment, but a serious enterprise AI platform with scale, momentum, and operating leverage. Second, search held its ground. Coming into this quarter, search disruption was the thesis risk I was watching most closely, not because I was certain it was happening, but because I wanted to see the evidence clearly one way or the other. Q1 gave us an answer. Search revenue grew 19%. Queries reached an all-time high, and management said AI experiences like AI mode and AI overviews are bringing people back to search more often. That matters. The concern was that AI would cannibalize search, but Q1 did not show that. If anything, the early evidence suggests Alphabet may be using AI to improve engagement rather than weaken the product. I am keeping this on the watch list. One quarter does not clear a long-duration disruption risk, but the early evidence is encouraging. Third, margin expansion despite capex. Think about what this quarter showed. Alphabet spent $35.7 billion on property and equipment in just 3 months, a massive AI infrastructure investment, and operating margin still expanded 2 percentage points to 36.1%. That tells me the underlying business has significant operating leverage. Revenue is growing faster than the cost base. The company is investing aggressively, but the core engine is still producing margin expansion. That combination, Growth, margin improvement, and heavy AI investment is rare. It is a sign of business quality. Fourth, subscriptions and Gemini momentum. Alphabet now has 350 million paid subscriptions, led by YouTube and Google One. Gemini Enterprise paid monthly active users grew 40% quarter over quarter, and management said this was their strongest quarter ever for consumer AI plans, primarily driven by adoption of the Gemini app. That matters because it shows monetization is broadening. Alphabet is not only monetizing AI through cloud, it is also starting to monetize AI through consumer subscriptions, enterprise software, and deeper engagement across its existing platforms. So the positive tailwinds are clear. Cloud is accelerating, search is holding, margins are expanding, and monetization is broadening beyond advertising. That is a strong readout. Now let's turn to the other side of the panel, what still needs monitoring. Now, the other side of the ledger. Every captain's log requires us to look at what we do not love or what still needs monitoring. 4 items. First, capex keeps rising and the ROI question is unresolved. Full year 2026 capex is now guided at $180 to $190 billion. That is up from the prior range of $175 to $185 billion. Alphabet spent $35.7 billion in Q1 alone, so based on the new guide, the remaining 3 quarters imply roughly $144 to $154 billion of additional spending. That is the most important open question for GOOGL. The bull case is that this spending is building irreplaceable AI infrastructure that can compound into durable cloud revenue, enterprise AI revenue, and stronger search monetization over the next decade. The bear case is that Alphabet is overbuilding in a hyper-competitive market where AWS, Microsoft Azure, Meta, and others are also spending aggressively. I do not know which outcome is correct yet. What I do know is this: the ROI on this capex is not fully visible at scale. The backlog is there. The demand signal is there. But backlog is visibility, not revenue. Now we need to see conversion margins and free cash flow follow through. Second, YouTube ads were softer than expected. YouTube ads came in at $9.88 billion, up 11% year over year, but slightly below expectations. That does not derail the thesis, but I want to watch whether this becomes a trend. Here is why it matters. Advertising is still a core monetization engine for YouTube. At the same time, YouTube Music and Premium had their largest quarterly increase in non-trial subscribers since YouTube Premium launched, and Alphabet's total paid subscriptions reached 350 million, led by YouTube and Google One. That is encouraging, but it also creates a question. Are we seeing a healthy mix shift toward subscriptions and AI plans, or are we seeing early softness in YouTube advertising demand? I am not alarmed, but I am watching the next quarter closely. Third, EPS normalization. Understand what you are reading. I already flagged this in the numbers section. The $5.11 diluted EPS included an estimated $2.35 per share benefit from non-cash equity gains. Excluding that estimated benefit, EPS was closer to $2.76. That is not fraudulent accounting. It is normal disclosure. But if you compare Alphabet's EPS to prior quarters or analyst estimates without adjusting for that equity gain, you are not making an apples-to-apples comparison. Use operating income. Use free cash flow. That is the real scorecard here. Fourth, antitrust is still in the background. The DOJ remedy phase remains active. Possible outcomes range from modest behavioral changes, like changes to default search agreements, to more aggressive structural remedies. The extreme outcomes, like a forced breakup, appear unlikely. But unlikely does not mean impossible. This is a long-duration, low-probability risk that could become more important, depending on what the courts decide. So this stays on the watch list until it is resolved. Here is the readout. CapEx is the main warning light. YouTube ads need another quarter of monitoring. EPS needs to be normalized, and antitrust remains a long-term overhang. The quarter was strong, but the flight is not risk-free. All right, let's check the altimeter. What is the market actually paying for Alphabet right now, and is that price justified? This is where valuation and business quality have to be looked at together. A great business can still be a bad investment if the entry price is too high. But when business quality is improving and valuation is below parts of its own history, that gets my attention. Let me walk through the table. Forward PE, approximately 18 times on a forward basis, versus a 5-year average closer to 23 times. So on forward earnings, the stock is trading below its own historical valuation range. EV to revenue, approximately 10.9 times versus a 5-year average closer to 6 times. Above average/premium. Now, here is the important correction. Free cash flow yield. Reported trailing free cash flow yield on enterprise value is not 4.5%. That would overstate the cash yield. Using reported trailing free cash flow, Alphabet's FCF over EV is closer to 1.4%, and that number matters. Alphabet's operating cash flow remains very strong, but reported free cash flow is being compressed by the massive AI infrastructure build-out. In other words, the operating engine is producing thrust, but a lot of that cash is being routed straight into the runway expansion. So I would not call the current reported free cash flow yield attractive on its own. Instead, I would call it capex compressed. That is the key valuation tension in this quarter. The business quality is improving, but free cash flow is temporarily pressured by the size of the AI investment cycle. Operating margin came in at 36.1% versus a 5-year average closer to 28%. That is important. Alphabet is operating more efficiently today than its historical norm, even while spending aggressively on AI infrastructure. Cloud revenue growth was 63% versus a historical average closer to 30%. That is not just above trend. That is a major acceleration. And then there is the number I want to highlight separately. ROIC, return on invested capital, approximately 30%. In the SkiesCapital framework, ROIC is the quality anchor. It is not just a valuation metric. It is a business quality metric. It tells us how efficiently a company converts capital into returns. High ROIC over time is one of the strongest signs of a durable competitive moat. At approximately 30%, Alphabet's ROIC remains elite by mega cap standards. That tells me the moat is not just defensive. The business is still compounding returns on capital. But here is the key distinction. High ROIC and expanding margins tell me the business is high quality. The low reported FCF yield tells me the market still needs proof that this AI capex cycle will convert into durable free cash flow. Both things can be true at the same time. Now, an honest note on my owner valuation model. In my April owner model, I had Google fair value at approximately $249 against a market price around $302. At that time, the stock looked overvalued relative to my assumptions. After this quarter, I believe that model needs to be updated. Cloud accelerated more than expected. Search held its ground. Margins expanded. ROIC remains high, and the valuation multiples on forward earnings and EV to revenue are below their historical averages. But I am not going to ignore the capex issue. Alphabet is now guiding for $180 to $190 billion of 2026 capital expenditures, up from the prior guide of $175 to $185 billion. That makes AI infrastructure ROI the key swing factor in the valuation. So, my updated view is this. The valuation picture has improved, but it is not a clean, cheap stock call. On earnings and revenue multiples, Google looks reasonable to attractive. On reported free cash flow yield, it looks capex compressed and still needs proof. That is why the thesis status is improving, not all clear. The business quality improved. The valuation is more reasonable, but the market still needs to see whether this AI investment cycle turns into durable cloud revenue, stronger search monetization, and eventually higher free cash flow. For now, the altimeter check says this. Google is no longer flying at an obviously stretched valuation altitude. The engines are producing real thrust, but the capex load is heavy, and we still need to monitor fuel efficiency. Thesis status, improving. Now let's translate the valuation into a practical entry price framework. At SkiesCapital, this is the boarding decision. The question is not simply, is Alphabet a great business? I think the answer to that is yes. The better question is, at what price does Google offer enough margin of safety to justify adding capital? Right now, the stock is sitting around the $385 level, which puts it right near the top end of my fair value range. Current market data shows GOOGL trading around $385.69, with a market cap of roughly $4.67 trillion. So I break the entry framework into 4 zones. First, above $385 stretched. At that level, I think the market is already giving Alphabet a lot of credit for cloud acceleration, AI monetization, margin expansion, and search resilience. Could the stock still work from there over time? Yes, but from a margin of safety perspective, above $385 is not where I want to be aggressive. At that price, the aircraft is flying at a high valuation altitude, and the capex ROI still has to prove itself. Second, $330 to $385 fair value. This is the cleared for approach zone. Using a forward EPS assumption around $14.50 to $15, this zone implies a forward PE range of roughly 22 to 27 times. That is not cheap, but it may be reasonable for a company with elite ROIC, improving margins, search still holding its ground, and Google Cloud growing more than 60%. But I want to be precise here. Reported free cash flow yield is not especially attractive right now. Alphabet's trailing 12-month free cash flow was about $64.4 billion after $109.9 billion of property and equipment purchases. That means reported FCF/EV is heavily compressed by AI infrastructure spending. So in this fair value zone, the stock may be worth holding, but new positions require patience. The next proof point is whether this capex turns into durable revenue, margin, and free cash flow. Third, $280 to $330 attractive. This is their runway in sight, prepare to land zone. At this level, the forward PE would fall roughly into the 19 to 23 times range, depending on the forward EPS estimate used. Reported FCF/EV would still be capex compressed, but the yield would begin improving toward roughly 1.6% to 1.9%. This is where the margin of safety starts to look more interesting. If cloud growth remains strong, search stays intact, and the market is simply overreacting to capex fears or macro noise, this zone becomes attractive for long-term investors. Fourth, below $280, compelling. This is the full throttle high margin of safety zone. Below $280, the forward PE would likely fall below roughly 19 times, and reported FCF/EV would move above roughly 1.9%. Even with free cash flow still pressured by the AI capex cycle. To get there, we would probably need a real thesis scare, a broader market sell-off, or a major reset in mega-cap technology valuations. But if the core thesis remains intact, cloud momentum, search resilience, margin expansion, and high ROIC, then below $280 would represent a much stronger margin of safety. So here is my cockpit readout. Above $385, Google is stretched. Between $330 and $385, it is fair value. Between $280 and $330, it becomes attractive. And below $280, it becomes compelling, assuming the business quality remains intact. The key point is this: I am not changing my view because the stock went up. I am changing my view because the business evidence improved. Cloud accelerated, search held, margins expanded, ROIC remains elite. But the capex load is heavy, and until AI infrastructure returns show up more clearly in free cash flow, I want a margin of safety before adding aggressively. That is the boarding price framework. Every good captain's log ends with the next flight plan. So here are the 4 waypoints I will be watching between now and Alphabet's Q2 2026 results. Waypoint 1, high priority, capex versus cloud revenue ratio. Alphabet is guiding to $180 to $190 billion of capex in 2026. That is a massive infrastructure build-out. For the thesis to hold, cloud revenue growth needs to remain strong enough to justify that investment load. It does not have to stay at 63% forever. That kind of growth will naturally decelerate over time. But if cloud growth slows materially while capex keeps rising, the ROI story weakens. That is the key. The market is willing to fund heavy AI infrastructure spending as long as revenue, backlog conversion, and margins prove the spending is productive. If that proof starts to fade, the multiple on the stock could come under pressure. This is the most important instrument I will be watching. Waypoint 2, high priority, cloud backlog conversion. The $460 billion backlog is a powerful demand signal. But backlog is not the same thing as recognized revenue. The next question is conversion. How quickly does that backlog turn into reported cloud revenue? Does management sound confident about deployment timelines? Are customers accelerating AI workloads, or are they pushing projects out? If backlog conversion accelerates, that supports the bull case. If management starts talking about delays, slower deployments, or customer hesitation, that becomes an early warning light. Waypoint 3, watch YouTube advertising trend. Q1 softness was small. YouTube ads still grew 11% year over year, so this is not a broken business, but I want to see Q2. 1 quarter can be noise. 2 quarters moving in the same direction starts to look like a trend. If YouTube advertising is softer again in Q2, or if management commentary points to advertiser caution, then it becomes a real point of concern for the broader advertising thesis. Subscriptions are growing, and that is encouraging, but advertising is still the core monetization engine for YouTube, so this stays on the watch list. Waypoint 4, watch AI search impact and query monetization. Queries are at all-time highs. That is encouraging. But the next question is monetization. Can AI-enhanced search maintain the same economic power as traditional search? Are AI overviews increasing engagement without lowering ad density? Are advertisers still getting strong ROI? And does traffic acquisition costs start to move in a way that tells us the economics of search are changing? This is where the AI disruption debate becomes more precise. It is not enough for people to keep using Google. Alphabet also has to prove that AI search can monetize effectively. So those are the 4 instruments I will be watching until the next earnings report: capex versus cloud revenue, backlog conversion, YouTube advertising trends, and AI search monetization. That is the next flight plan. All right, let's bring this in. Remember the flight I described at the beginning of this video? Cruise altitude, rough air, passengers nervous, bad news coming out of the cabin. In that moment, you do not fly by emotion. You check the instruments. And in the cockpit, you do not trust one gauge. You cross-check the entire panel. That is exactly how I look at Alphabet after Q1 2026. This was a thesis-defining quarter. Not because the numbers were flashy, although they were, not because the stock reacted, although it did, but because this quarter answered some genuinely hard questions about the direction of the business. Cloud acceleration looks real. Search held its ground against AI disruption. Margins expanded while Alphabet continued spending aggressively on AI infrastructure. ROIC remains elite, and the $460 billion cloud backlog gives powerful visibility into future demand, even though it still has to convert into recognized revenue. Are there risks? Absolutely. The capex commitment is enormous, and the return on that spending is not fully visible yet. YouTube ads need to re-accelerate. The antitrust process is still running in the background, and reported free cash flow yield is capex compressed because so much cash is being routed into AI infrastructure. Those are real considerations. They are not noise. But when I look at the full instrument panel, revenue growth, cloud trajectory, search resilience, margin expansion, ROIC, and valuation relative to history, the readout is clear. The business quality improved. The valuation is mixed, but more reasonable than it was. And the thesis is stronger coming out of this quarter than it was going in. So here is the captain's call. The flight path for Alphabet is climbing, not descending. Thesis status improving. If you found this captain's log useful, please like and subscribe. It genuinely helps this channel reach more long-term investors who are trying to think clearly about the companies they own. And if there is a company you would like me to open the captain's log on next, drop it in the comments. I read everyone. This has been Captain Pierce with SkiesCapital. Think clearly, invest better. For educational purposes only, not investment advice. Captain's log out.